Welcome to the ETF Show, taped here at Asset TV's studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, ETFs are having another banner year in 2026. Despite market volatility and geopolitical risks, more than $600 billion has poured into exchange-traded funds so far this year. Now, while most of that money has poured into equity ETFs and S&P 500 funds in particular, there are some standouts, like the ProShares Genius Money Market ETF, IQMN, which had one of the best launches this year, or Roundhill's Memory Chip ETF, that's ticker DRAM, which has captured investor interest and about $10 billion since it started trading at the beginning of April. And the ETF space has been exploding with innovation. The options income category, for example, has grown to more than $150 billion. Here to discuss more is Aga Kuplinska, Senior Vice President of Product Development at Tidal Financial Group. That's a white label provider that helps bring ETFs to market. Aga, thank you so much for joining us today.
Thank you for inviting me on the show.
So I want to step back a little bit. Let's take the 10,000-foot view. I'm curious to know what you think is really driving the demand for ETFs right now. As I mentioned, we're on pace for another record-breaking year in 2026.
That's right. The ETF demand is being driven by the wrapper itself. Issuers find the wrapper to be super speedy to bring ideas to the marketplace, and investors love the easy access to the investment ideas through the wrapper, as well as tax efficiency. So it has become the default wrapper for everything from core beta to income alternatives and other strategies, and also model portfolio implementations. And right, I would definitely agree. We are on track for another record year for the ETF ecosystem.
So speaking of some of those products, and product development is your bread and butter, how would you really sum up 2026 so far, at least from a product perspective? What are you seeing as the top products and innovations right now?
2026, in my opinion, is shaping up to be the year of strategies moving to a portfolio engineering, portfolio architecture. The most active areas are active ETFs, the options income, the defined outcome, the alternatives, leverage, digital assets, and very niche thematic exposures. Active ETFs remain especially important. As you know, the space was predominantly passive back several years ago, and now majority of the products that are being brought to market are active. I think around 30% of all US ETF flows are active as of last year, despite representing a much smaller share of the total ETF assets. So there's a lot of innovation that is taking place in the ETF wrapper, and investors are taking note.
Yeah, the active ETF category, as you mentioned, has captured a huge share of flows, not just for 2025, but even into 2026. Now, you mentioned options income. That category, as I mentioned, is now in a $150 billion category, even though options income has really only been around for a very small slice of the total ETF timeline. I'm curious to know what you think is behind that surge, particularly for the options income funds.
Income is one of those themes that never goes out of fashion, never goes away. Income has always been in high demand, and investors want income in a very familiar, very liquid, daily priced wrapper. And options income in particular is the latest sort of innovation within the income theme and in the ETF ecosystem, and it allows investors access higher level of income than they would have if if the strategies were long only equity portfolios, and investors as well as issuers are innovating. Investors' demand sort of never dies, and issuers are innovating with all the different option strategies to bring alternative income strategies to the investor base.
So I'm glad you mentioned that piece around the innovation that is really coming to these sectors of these spaces that investors do know and are familiar with. Because I am curious to know, when it comes to these funds, the options income funds, and then I'm going to ask, just more broadly, Do you think investors actually know what's going on under the hood of some of these funds, or are they just chasing yield? Because as you mentioned, income has never gone out of fashion. Investors love income, but do you think they're understanding these particular types of income funds?
I think it could be both. Sophisticated investors understand the trade-offs between the premium income as well as capped upside. The path dependencies. And the fact that income generated through options will have a different impact on the overall performance of that particular strategy. But of course, there are investors. There's definitely an investor segment that looks at the yield, doesn't really understand, the options built behind it. So I would say that there is both. There are investors that are chasing yield, and there are funds out there that are built with high yield sort of objective in mind. But there are also funds out there, ETFs out there, that provide a more conservative income profile, while also providing some upside potential. So I would say it's both.
So it sounds like you think there's a lot of sustainability, particularly in this space, again, because investors do love income so much, instead of this being some kind of new sort of flash in the pan type of strategy, right?
Right. So I think the demand for income is definitely sustainable. Now, the number of very similar products probably is not sustainable, because eventually will run out of underliers that we can, that we can use options overlay strategy on. I would expect that the entire income category will eventually separate into products that are durable, with very clear use cases, with transparent distribution policies, versus products that simply compete on the highest yield.
What would you say is truly new out there, at least innovation-wise, as opposed to just sort of repackaging some of the strategies we've already seen?
So I would describe real innovation as not just putting an old strategy, or a mutual fund or an SMA into an ETF wrapper. It is basically using the ETF structure to deliver exposures that were previously very difficult to access for retail investors. So options overlays, and that could be for income, for hedging, defined outcome strategy, sort of return stacking, or other derivative-based strategies, even private, type investments, or exposures, and also the way portfolios are being created these days and backtested. The entire, the sophistication is much greater. So the innovation isn't so much about the repackaging is basically like relaunching similar strategies already out there in the ETF wrapper. Innovation is all about creating new strategies, new exposures, new ways of delivering certain objectives and outcomes for the investor.
So what you really have sort of been describing is really the democratization of complexity. And everyone has always said that the reason they like ETFs is because it is about democratizing for the investor. But I'm curious to know if you think ETFs are actually becoming too complex right now for the investor.
Some probably are. Complexity is not bad, in my opinion, for as long as it is explained. A product can be very sophisticated, sort of behind the scenes, but can still have a very clear use case. So the problem is when the sort of marketing message, the positioning, it's is simple, but the payoff profile is not, meaning the complexity of the strategy is not, but the positioning and the description of that particular strategy, so that it can be relatable to the investor, that could solve a lot of the complexity problems in the space.
What about for advisors? Do you think that the innovation that we're seeing is also outpacing even advisor understanding as well?
Well, hopefully all advisors keep tabs on what's going on in the investment management world. The best advisors probably are keeping pace, especially the ones that manage, don't use, for example, home office models for their asset allocations. But product education directly to retail investors as well as to advisors is definitely becoming a bigger part of distribution strategy for a lot of issuers. Advisors need to understand not only what the ETF owns or what the ETF invests in, but why it behaves the way it does in different markets and what to expect.
All right, so I want you to pull out your crystal ball for us for a second, because I'm curious to know what you're really seeing is coming up next when it comes to product and innovation, not just for Q2 and Q3, but really truly for the remainder of 2026.
So I would expect definitely more active ETFs. That's where the majority of new launches sit. More variation for options income. We should see more digital asset linked strategies, multi-asset allocation products, and alternatives. And I would also expect to see that the products that are being designed right now and roll out in the marketplace, they center around specific outcomes, like income targets, volatility management, downside hedging, inflation hedging, as opposed to the traditional broad-based beta exposures.
I'm curious to know, right, that's where we're seeing a lot of the innovation, but are there sectors right now where you're seeing a lot of experimentation, where we might see some innovation much further down the line? What sectors would those be?
Not necessarily a sector, but I believe income will, continue to be the most sort of active product lab space. Then I would expect to see more innovation within the leverage category as well as defined outcome. And then on the sort of long only traditional side of things, thematics, timely thematics, for example, in recent times, we have seen a lot of different flavors of AI type, strategies being brought to market. So niche timely thematics is also where I would expect most sort of experimentation taking place going forward.
Now, we've already, heard, and you've even said where a lot of investor interest is currently when it comes to some of these new ETF types, these new innovations, these new strategies. I'm curious to know if you think that there's any areas where investors are not paying attention, but really should, to some of these products that are either already out there or will be coming out.
So going back to income, distribution quality, for example, not just distribution level. We always encourage investors to ask, where is the yield coming from? How much upside am I giving up? How will this strategy behave in a sharp rally, for example, or volatile market or market collapse? And is the distribution sustainable? So digging a little deeper into the sources of the distribution. So overall distribution quality, I would definitely recommend anyone to pay closer attention to.
All right, so I haven't asked you about this yet, but I have to ask about one of the most anticipated things that is going to be brought to the ETF wrapper. That's private markets. It's really dominated a lot of ETF conversations lately. I'm curious to know if you think we're close to solving some of the biggest hurdles when it comes to putting private markets inside of the ETF wrapper. Liquidity is a huge one, for example, or do you think we're actually a little bit maybe too early right now in trying to fit private markets inside of the ETF wrapper?
The ETF wrapper doesn't lend itself very well to holding private type investments and or less liquid investments, because it needs to be the ETF trades, intraday. The ETF wrapper needs daily liquidity, the pricing transparency. There's also the creation and redemption mechanics. The regulatory cap for privates or for illiquids is 15%. We have seen a lot of issuers, including on our platforms, wanting to add small allocations to privates in the ETF wrapper, but the regulatory sort of limits as well as the mechanics of the ETF sort of prohibits from any large exposures.
All right. Well, Aga Kuplinska, Senior Vice President of Product Development at Tidal Financial Group, thank you so much for joining us today. And thank you for tuning in to the ETF Show.